So there will be a way to verify the wage that you are reporting with whatever your employer is reporting as a wage. And we have electronic billing information that in a minute I will tell you how it gets introduced in this. So I know that the talk is very short, but this is a little bit of the outline of what I'm gonna do. I'm gonna have a very small conceptual framework kind of to motivate and to explain the results that we are gonna then see on the data. Gonna talk what exactly is that we are using, our estimation, and thinking about the results when we find and what are the policy conclusions from that. So a little bit of the conceptual framework, it's if I have a withholding system, can employees have income? That is basically the motivating question. So to do this, the first change that we're going to make to the regular evasion model is saying the probability of the tax authority to you detect that you are on the reported income will have two arguments. One will be the size of the underreporting income, so the size of the evasion, and the other one will be the firm size. And a little bit of the firm size is there are two reasons in the literature that talks about the firm size. One is in the sense of let's think that we have a group of individuals that have different productivities, and the more productive is an individual, the self-employed option will give you a higher return because you are more productive. But you can also work for a firm, but the larger the firm, the higher is the productivity kick that you get from the firm. So basically the idea here is like, how come we have small firm sizes that stay small for a long time? Because you should never get very productive individuals because they will be better off being self-employed. So one of the reasons that to explain this, the existence of small firms is like, in small firms you may be able to underreport income. And the other one is basically a collusion story that is saying the smaller the firm, if you are hiding some of the income that you are getting for your employer, there is certain collusion between employer and employee, and the larger the firm is more difficult to sustain this collusion because there will always be the threat of a whistleblower. So in any of those two theoretical reasons, we can say like, well, this probability will be increasing on the size of the firm. So a little bit of notation here, we have real income, Y bar, and reported income, Y. The underreported income will be the difference between those two. Kappa will be the firm size, and I have this probability that it has these two arguments. The penalty will be multiplicative. So let's think of like, for every dollar of tax that I'm hiding, I have, if it is discovered that I have been hiding that, I have to pay more than that dollar. So basically, after this is the regular tax evasion of crime model, in which what I'm actually is doing, I'm maximizing the expected return of this decision of like hide income or not. There would be one scenario in which I'm not audited. The tax authority does not realize that I'm hiding income. Therefore, I will get as part of my return everything that I'm hiding as a payoff. And the time in which I'm audited, they realize that I'm hiding income. Therefore, I have to pay the penalty. And in this very simple model, the thing that matters here is, while the marginal benefit, that is this dollar that I'm hiding, that I don't have to pay a tax for like this dollar that I'm getting for not paying that tax, that marginal benefit is constant. While the marginal cost of hitting that extra dollar is increasing on this cap on the firm size, because the probability keeps changing. The probability of like me being caught increases, so the expected marginal cost of hiding increases as the firm size increases. So what we should expect to see, if there is wages that are underreported, that should have a correlation in the firm size. So it should be more likely to have underreported wages on smaller firms. So basically this part of, I don't need to tell this audience a lot about Ecuador, but this is usually what I say when I'm doing this on an international audience. We have a middle income country with a progressive income tax. And we have one characteristic that makes that will be important later on for the estimation. We have this deduction for personal expenses that creates an incentive to ask for a receipt with your tax ID. That it will be the tax ID of the cedula. We deal with that on the empirical part. And we have a tax year and we have a withholding system. So basically your employer would withhold part of your salary and report it directly to the tax authority, so the tax authority know your salary beforehand. So basically, we have two sources of data, the reported income and this employer-employee relationship. So I know who is your employer and for how long have you been working for that person. And the electronic billing system started in 2012. By 2017, more or less the 75% of the sales that are reported on BIT were already on the electronic billing system. All the incorporated firms, that it will be what we in Ecuador know as sociedades, and non-incorporated firms that are las personas naturales obligadas a dar contabilidad, and everybody everybody that has these machines that print out the receipt have to be on the electronic billing system. And I have at least on the version of the data that I had access to, I had basically for every firm that is in the electronic billing system, how much per month every tax ID has buy from. But I know from the information from the firm the economic activity that has this person. So basically, what we are going to do is say, for this buyer, so for this citizen, either if he's using his tax ID of the cedula number, I know how much it has reported from this grocery store, so I will make this as a proxy of consumption of food. And a proxy of total consumption for that person. So basically, this is a third-party reporting information too. I'm not telling the tax authority how much was my food consumption, but they can observe every time that I went to the grocery store and I asked for a receipt on my name. And then the estimation is kind of like a very simple kind of old estimation with a little bit of flavor. Is the Pizarro and Weber methodology, that basically the idea here is saying, I'm gonna have, there is no reason to believe that a public sector employee and a private sector employee have different preferences of consumption of food if I keep constant their demographic characteristics and the level of income. And if I observe any systematic difference in this reporting of consumption of food, in this relationship between the consumption of food and the level of income, that may not be because they consume different levels. It may be because they are hiding income. What I'm using public sector versus private sector, because there's no way for a public sector employee to agree with his employer, which is the government, to be paid something on the side, to avoid contributions to Social Security and to avoid income tax. So the big assumption here, and then on the robustness checks, we do several things to try to prove that this assumption, it's at least sensible in the Ecuadorian context, is like similar individuals will have similar consumption patterns. In particular of food, we do it for total consumption, independent of the source of their income. And the estimation, it's a nonlinear estimation. So basically I have on the left side consumption, on the right side, I split, and this is the nonlinear part, the income between visible income and non-visible income. So the visible income will be my public sector wage, and the non-visible income will be the private sector wage. Because they may be basically a chance that the private sector wage may not be fully reported. And then I have a dummy there in case there is a kind of a systematic difference between the private sector and the public sector wage. So there will be a constant term there. And then I add demographic characteristics to try to balance this preference over consumption. Okay. So here, basically, the null hypothesis is that this k variable is equal to 1. There will basically be no difference between the income of the private sector and the public sector employees. If it is larger than 1, it means that the private sector employee is systematically underreporting the income compared to the public sector employee. So there is part of the wage that is not being reported to the tax authority versus the public sector employee. And the way we are going to read this parameter is for each dollar that the public sector employee reports, the private sector employee will have reported 1 over k. I lost you for a minute. I don't know until...
Sí, te escuchamos.
Sí, perdón. Yeah, so the idea basically will be something like for each dollar that the public sector employee, the private sector employee will report this amount in some sense. So basically the main estimation, it's basically telling us this. We do this in several ways, included residency fixed effects. So to account for the fact that not in all the occasions you have the same number of wages from the public sector. So we are controlling for where you are living. And basically what we find is for every dollar that the public sector employee reports as wage, a private sector employee reports only 93 cents. And it's more or less, it's a little bit bigger we use total consumption instead of consumption of food. But the interesting part is what happens when we start looking at this gradient. How big is the firm? So as we increase the firm size, so here I have I have a very big gap on this reporting between the public sector and the private sector if I'm working for a small firm. So if I have 3 or less employees, this parameter is 1.34. And the way to read this is if I work for a small firm, for every dollar that the private sector employee, for every dollar the public sector employee reports, the private sector employee will report around 75 cents. And this evasion gap, so this envelope wage, starts disappearing as I keep adding, as I keep increasing the firm size. So once I have large firms of 50 employees or more, there's no difference in patterns of consumption between public and private sector employees. So we can say there may be something else different between the public and private sector employees. So we do several things to try to alleviate this concern, because basically our identification assumption is the only thing different that I have between a public sector and private sector employees is this opportunity to hide taxes. So to hide income to avoid taxes. So the first thing we do is we repeat the whole estimation with survey data. So we use the Encuesta de Condiciones de Vida, the last one of 2017, I think. 16, 17, that is more or less at the same time. And we find that for a comparable sample of individuals, this parameter that we are estimating is no different from 1. So basically, we look at the survey data when you are answering in the survey your income and your consumption and everything, and then we calculate consumption of food. I don't find any systematic difference between public sector and private sector employees. Then we can think, why I don't see all consumption. I only see consumption through this third-party reporting system. There is the electronic billing system. So what would happen if there are systematic differences between public sector and private sector employees in where they go to buy? In that sense, this measurement of consumptions will be biased in some way. But we don't find any evidence that one individual will systematically try to have their consumption. So we don't see that public sector employees are more likely to go to a formal grocery store, once private sector employees are more likely to go to a farmer's market. So there is no systematic differences on the probability of show up as having bought something through the electronic system. Then we have this idea of like, well, given the way that the tax system is set up in Ecuador, we don't have a reporting of households. There's no joint family. It's only an individual thing. So I basically don't have family units. And you could have this case in a household that one member of the household is the breadwinner and the other member is the primary spender. So the person who goes to the grocery store, blah, blah, blah. So to try to alleviate this, we repeat the estimation using only single individuals. So if you are single, you are less likely to have this problem that someone in your household is buying the groceries versus someone else is earning the wage. We basically repeat the estimation with single individuals, only with that sample, and there's no big change in the estimation. Then we have this idea of, in general, in the public sector, you can have lower wages, but people tend to take these jobs because it's less likely for you to be fired. If you already had a tenure in the public sector, it's less likely for you to be fired. Therefore, you will have to give less monies for precautionary savings. If you are having less precautionary savings, therefore, it may be that you are spending a larger share of your consumption of food, on your consumption of food, in a larger share of your income in general consumption, because you don't have to save for the future that much, because your job is secure. So basically what we do is calculate the number of months that person, public and private sector employees, are working for the same company. And what we find, it's like basically it is true that the public employees systematically consume a little bit more as they older, as they keep staying more months in the same job. So once you have been 5 years, 6 years, 7 years in the same job, it's less likely for you to get fired. You start consuming a little bit more. So basically what we do is restrict the sample to individuals with older tenure in both sectors. And then what we find, what happens here is basically that people who have been working for a long time in the private sector is people that is working for big companies. So basically what we end up are comparing is public sector employees with long tenures with private sector employees with long tenures. And in that case, the relation switch. So basically the ones who are spending more are the public sector instead of the private sector, which tells you that there may be this behavior of like a public sector employee has at least thinks that he is less likely for him to be fired, so he saves less. If that is the case, we shouldn't be comparing of estimation with one, but with a value lower than one. But this kind of behavior goes against of estimation. So basically we think of, okay, if we are calculating this evasion gap, basically what may be happening is like we are estimating a lower limit of the evasion gap, this hiding wages. So the first thing that we start thinking of what is the policy implications of this. So the first thing that we did is we are following the literature of evasion gaps and try to think of what are the implications for national accounts. So basically here I have a semi-formality. There is underreporting of revenue for a part of the society that will be households. So if I were to correct this, how large our GDP will be and what those implications will be. So basically what I'm thinking is I'm correcting if I will gonna use the average gap or reporting of on the reporting of income and correct that. So if everybody in average will report the amount that they should report, how larger will be the true income, how large is this on the report income. So this is basically what I keep doing row by row. And the first one is the average reported annual income. The degree, then I have the degree and the reporting income. In row number 3, we calculate how much the income will be if everyone will be reporting truthfully. We have an estimation of what will be the registered contributors on the private sector. And then we calculate how is the amount of the underreported income. And then we have to say, look, okay, these households, how big is the percentage of GDP that these households represent? And we have from national accounts that 69% of GDP corresponds to household consumption, but we don't need to see all household consumptions. Basically, households get split into 3 groups: the ones that are self-employed, the ones that are like public sector employees and private sector employees. So we basically try to estimate the size of the private sector employees' households, and that will be 49% of the GDP. You just take the GDP of the country and try to estimate how big is the shadow economy of hiding this income. That we are gonna talk about the intensive margin of these employees of the shadow economy. So it's not accounting for informality, but for this employee that was reported, but whose wage is not truthfully reported. And we estimate that the calculation of the GDP is off around 3%. And then we kind of recalculate income tax, and we say that it's not a large number. It's like somewhere around the ballpark of $100 million. But the problem, like, this is a small percentage of the tax collection, but it's around many taxpayers. But since we have a flat social security contributions, because like income tax is progressive, so the larger gap is on smaller firms that tend to have lower salaries, so they don't take to pay much income tax. But social security contributions is kind of a flat rate, and this is a large number for unpaid social security contributions. It's around 8% of the total social security contributions. So what is all back on the envelope calculation here? That because of this kind of evasion that is basically on the report their wage, we have an income tax loss of around 1% of the total tax revenue, but around 9% of the total social security contributions. So here the policy question is basically saying, well, this will be the best strategy for the tax authority to try to monitor small firms. And the question, like, it's basically an open question, is for the tax authority to decide. But from the literature, there are 2 things that could happen here. A lot of the tax collection comes from basically a tax morale, so the willingness to pay taxes, not because I'm being monitored, but because I think that is a good thing to pay taxes. So if you start going after small firms, that may create some resistance, and you may lose some tax collection because people is less willing to pay taxes, given that you are trying to get tax collection from the small firm rather than from the large firm. And the other thing is, like, monitoring is expensive, and here the return we have $100 million, but over many taxpayers, and there is kind of a fixed cost for each taxpayer to be monitored. So like this may not be a good idea. On the other hand, we have payroll taxes, which is basically Seguridad Social, and that gives you two benefits. The retirement benefits, but those are basically calculated over only 5 years of your highest contributions. So if you are very young, of you have been paying for the system for a long time, and you are predicting that your 5 years are in the future, of your 5 years of the highest salary has passed, there's no incentive for you to report high salaries in any other point. The other thing that you get from payroll taxes is this access to Social Security healthcare. That let's not talk about if it is good or not, but there's a yes or no question. It doesn't matter how much wages you are reporting, you have the same access to the healthcare. So there is no incentive to truthfully report your wage from the payroll tax. So basically, one part of our policy recommendation from this evidence is like, they may be a better idea to realign these employees' incentives. It may be a better policy choice. If we look at the region, there are two experiences in which, in Mexico and in Uruguay, when there were Social Security reforms, basically you start, and now the benefits get tied to the reported wage. Suddenly, from 1 year to the next, the amount of wage, the average wage of small firms and from young taxpayers increases dramatically. So that may tell you that something similar what we are finding in Ecuador, it's happening in other places in the region. And the best way to solve this is this realignment of the employees' incentives to not accept envelope wages, basically. So force their employees or not accept contracts in which not all their wage is reported direct. All their wages reported directly to the government, because I get something from that. That is not the current structure that we have in Ecuador. What is this? Part of the conclusion is like, this third-party reporting system of withholding on wages may not be a good instrument to prevent tax evasion in places where you have relatively weaker institutions. So it works really well in the US, it works really well in Switzerland, doesn't quite work in Latin America. There's a clear gradient between this underreporting wage with firm size. So it tells you something that there may be a story of collusion. That's why the larger the firm, you don't see anything else. And the larger impact on the government finance are on the size of Social Security contributions. Therefore, the solution of that, like if something will want to be done about this envelope wages gap, the solution may be on the Social Security side rather than on the tax authority side. Thank you. And I think I almost did my half an hour.
Muchas gracias, Andre, por la presentación. Bueno, pasamos ya a la ronda de preguntas. Por favor, si alguien tiene alguna duda o alguna consulta para Andrea, adelante. ¿No tenemos preguntas? Bueno, yo empiezo con una pregunta, Andre, que me quedó la duda. Sí, sobre todo de lo que mencionabas de México y de Uruguay. No me quedó muy claro qué es lo que ellos aplicaron a nivel de seguridad social.
Básicamente, ambos, los mexicanos y los uruguayos, tenían un sistema muy parecido al nuestro, que básicamente tu pensión se calculaba sobre los últimos años de que estás trabajando o sobre los años que tu salario ha sido más alto. Y tenías acceso indiscriminado, independientemente de cuánto reportabas, a el servicio de seguridad social, o sea, al servicio de salud. Lo que hicieron en la reforma en México fue básicamente pasar del sistema piramidal a cuentas individuales. Entonces, ya tu pensión dependía de todos los meses cuánto estabas aportando. Inmediatamente, cuando empiezas a hacer eso, los salarios reportados aumentan drásticamente y aumentan, ellos no tienen información a nivel individual, pero tienen información básicamente por parroquia. En las parroquias en las que tú tienes empleados que son de menor edad o que hay empresas más pequeñas, hay un incremento mucho más grande de los salarios reportados. Ahora que tu impuesto, o sea, que tu pensión de seguridad social depende de cuánto salario estás reportando y va a depender cuánto recibas de todos los años, de cuánto reportes. El de Uruguay fue un poco distinto. En Uruguay lo que hicieron es, en Uruguay tú puedes trabajar por horas y antes de la reforma lo único que pasaba es que independientemente de cuántas horas trabajes, tú accedías al sistema público de salud. Entonces, si tú trabajabas 10 horas al mes y reportabas sobre eso, eso sí afectaba tu nivel de pensión, pero no afectaba tu nivel si tenías acceso a seguridad, al servicio de salud. Entonces, básicamente, ¿qué es lo que hicieron? Es decir, bueno, tú puedes acceder como individuo si trabajas 20 horas, pero tu familia puede acceder al servicio solo si trabajas 40 horas. Y de repente, y claro, por el número de horas tú pagas sobre tu salario y tu salario está calculado sobre el número de horas que trabajas. Los empleados empezaron hay un movimiento de un montón de gente que antes decía trabajar menos de 40 horas y de repente trabaja 40 horas, de un mes al siguiente. Y nada más pasa en la economía. Entonces es un poco que la cantidad de trabajo en la economía haya aumentado drásticamente de un mes al otro solo porque hay este cambio. Lo que te dice es que no es cierto que antes no trabajaban 40 horas, sino que no se reportaban las 40 horas. Entonces, no reportabas el salario completo porque no había ningún incentivo para reportar el salario completo por parte de Seguridad Social. Y claro, con el impuesto a la renta, siempre mientras menos reportas, menos pagas.
Chévere, muchas gracias, André. No conocía antes de este tema. ¿Tiene tal vez alguien más alguna duda, alguna consulta? Chicos de la maestría, adelante. Ustedes que están ya por empezar su trabajo de disertación. No, bueno, creo que no tenemos más preguntas, André. Igualmente, muchas gracias por
Muchas
tu
gracias a todos
presentación.
por venir
Igualmente,
en la
sí.
tarde y todo.
Listo. Muchas gracias, André, por la
Gracias.
presentación, por este espacio. Es súper importante para nosotros estas charlas y poder conocer también de la investigación pues, de nuestros docentes. Eso es vital. Entonces, muchas gracias a todos. Que tengan una
Gracias a
excelente
todos por la
noche.
invitación. Buenas
Nos veremos
noches.
en la próxima. Hasta luego.
Hasta luego.